Are
All right.
you
Yeah, we're live.
okay on Facebook?
Yeah, well, not on social media yet, but just
Okay.
the attendees. All
Okay.
right. Let's
Okay.
wait for let's start at, let's say, give us 3 minutes, or two. Let's do 2 minutes. How's that sound? Because we do have a lot to go through. So
Yep.
hi everybody. Yeah, we'll just wait another 2 minutes for the rest of the audience and team, to everyone to come join us. So if you're on the call already, let's put in your where you from in the Q&A box. Uh, and I'll let me start by saying hi there. Yeah, we'll start in another minute.
I see some familiar names.
That's right. I see Neo. Hey Neo, thanks for joining us.
Yeah. Hello. Please type in where you are from. I know Henry is on vacation. Henry, why don't you share your location?
Yeah, so I am in River Gorge, right by the between Washington and Oregon. So there's a Columbia River, and it's a really nice vacation spot. Actually, out in that direction is the water. Very scenic.
Nice.
Yeah. All
Very
right,
nice.
let's give another minute before we start.
Mhm.
All right, so Neil says he's from Bay Area. Yeah, that's
Very
probably
brave. The first one to break the ice.
that's definitely a lot of people that either I think from the Bay Area and also from Jersey and New York.
Yeah, I do see a lot of people from New York or New Jersey.
Oh
Oh,
yeah,
wow. Wow,
Kathy,
nice,
hi
nice.
from
Um,
Scottsdale, Arizona. All
yeah,
right.
I am going to spend a month in Arizona as well.
Are you? Oh, when are you going?
Um, so I will spend maybe 10 days play around like all those national park, and then I will go to Phoenix and then Flagstaff. Is it that called? And then
Yeah,
also
Flagstaff. Yeah,
yeah, and
yeah.
then on south there's called Sedona, and then another one is called um, I forget on the south side. So basically, I want to figure out the real estate market there.
Yeah, that's awesome. Yeah, great market. Yeah,
Yep,
FYI, we have an apartment building there in Phoenix, so good to
yep,
check it out. And
yeah.
also Gary from Bay Area. Hi, San Fran. Awesome. So I think it is time. Why don't we get going here? All right, so let me get started here real quick. All right, so all right, hi everybody. Well, I'd like to thank everyone for joining us tonight. Really excited to share this co-investing opportunity that is exceptionally recession resistant. It is a great asset to own in this new era of tax hike. Our goal for the webinar is to keep it within 1 hour and 15 minutes for questions. Everything within 1 hour, I should say. So we have people from both East and West Coast in various time zones. There's a lot to go through, and we'll open for Q&A at the end. Please use the Q&A box at the bottom of the screen and fill it in. All right, let's get going. All right, this is our legal housekeeping. First off, we're not investment advisors, so always do your own due diligence. Private equity is illiquid, so there's always some degree of risk, which are outlined in the PPM documents. What we have tonight is an overview of the offering. This opportunity is a File 6C offering for accredited investors only. If you're a sophisticated investor, you're welcome to listen, but we'll provide everyone a recording of this webinar. And we go through the slides too quickly and you want to review them in more detail, the recording will be made available. All right. Clicking on the next button. All right. So this opportunity is like any real estate investment with cash flow and tax benefit. What set this deal apart is the high 21% cash on cash return. Also, the fund can achieve this without using any leverage. Obviously, the manager can juice up the return by taking additional leverage, but the deal is already in double-digit IRR. So I know we have many real estate investors on this call, and myself included. So if the rest of our portfolio are leveraged, then this is a great way to balance your portfolio. Lastly, if you're about to experience a large capital gain in 2021, and listen up, this is very consequential. Most real estate deal is not 100% depreciated. You have land and other fees that are not depreciated in the same capacity. With this deal, 100% of the asset you invested is depreciated. So I know we have been keeping it as a suspense, and we promise we will tell you everything in just a moment. So this is our agenda, and it is broken down into 4 parts. We'll first start with an introduction of our company and our team, our own experience, and our investing philosophy. Second, we'll take a deep dive into the opportunity and discuss why we think this investment is recession resistant. We'll talk about the business model, risk management, and the financials. Third, we'll go through the portfolio management concepts, such as how this opportunity is compared to a traditional multifamily and how it can enhance your investment portfolio. We will reserve time at the end to answer your questions. If we run out of time before we finish answering all the questions, we'll follow up with you or make a short FAQ video to address them. We will also have an exit poll at the end, so if you can't stay till the end, please send us your soft commit before the 9th. All right. So let me introduce the team. All right, so for those of you who don't know us, Sharp Investor is a private equity group. Our focus is to invest together with our passive investor to achieve a symmetrical return with downside protections. I'm Henry Yun from Seattle, and I'm married with 2 kids. I have an engineering background and work as a project manager in a Fortune 500 company. About 9 years ago, I caught the real estate bug and founded a company with my partners. Since then, our team has renovated over 50 projects and built 5 single-family homes. We're still managing our rental portfolio, and we're a super host on Airbnb. My own experience has taught me that working in a team can make a bigger impact and more rewarding than going alone. Plus, it's more fun. I'm excited about this project, and thanks everyone for joining the call.
Hi everyone, my name is Xian Yan. As a market risk manager at Wall Street, I have a healthy dose of skepticism and I take calculated risk. Just like you, I experience a lot of struggles as individual passive investors. I believe the co-investing model is the solution to solve my own problem and yours. That's why at Sharp Investor Group, we offer a one-stop solution to clear the hurdles in your investing journey. I'm a quick learner, an independent thinker, and I'm very passionate about sharing. Many of you attended my an hour-long educational webinars on various topics. At the bottom, you can see some sample webinars I did last year. Those talks were originated from some conversation with investors. All of this can be found on our website, www.sharpinvestorgroup.com/webinars. Welcome to subscribe to our newsletters if you want to be notified about new educational webinars and new deals. Lastly, in my free time, I enjoy running. My marathon record is 3 hours and 35 minutes. Marathon training is easy. First, you need to take a long-term plan. Second, you put it on your calendar. Third, be disciplined and show up every day. And also, don't forget to manage the risk and don't get injured. Lastly, be patient because you're not going to see the result every day, but eventually you will get to the finish line. So this is our team, an exciting technologist plus a boring numbers person. Next.
All right, it's my turn. So thank you, Yan. So let me talk about my real estate journey. When I was young, my parents saved every penny to buy real estate. And I saw it firsthand how that has changed our financial future. But I didn't get into real estate until much later. I went into engineering and I got a job in aerospace. For about a 20-some-year-old, it was the dream job because I get to travel for work and work up my mileage points. I would never have paid for it on my own for a business class ticket and stay at a 5-star resort. But it was the highlight of my career. But when my first kid was born, I started to think about I need to make a change. And growing up, my dad was not always around, so I want to be there for the family. Also, what happens if I lose my job and everyone knows, that aerospace is somewhat cyclical. So my wife was also focused on her career, so I needed to help out and spend more time with the family. And that's why I got into real estate. So I bought my first rental and made all the mistakes possible. It was a nightmare, but I was lucky. The market was good and I learned how to deal with contractors and manage constructions. And later I partnered with friends and we scaled up and doing multiple flips at a time. But it was the most stressful time of my life. So I'd like to share some of my lessons and let me put that up on the screen. So it was just like a second job when I was doing flipping and I had even less time with my family and I had to pay more tax. And I also had to take more risk and personally guarantee the debt. I feel I was just farther away from my goal. So if I were to do it over again, I would hold on to every single flip. All my rentals are still doing great, and for the most part, it runs on an autopilot once I have the right management in place. Also, I get to write off a lot of taxes. So now I went back to the drawing board and decided that I want to invest more passively into asset that is A, tax efficient, and B, have a better economy of scale. And I don't want to trade time for money. I also want to maintain my engineering job as a second source of income. My goal is to be able to choose when to quit, when it's not fun anymore, when I have the financial freedom. And I'm also a conservative guy. And what if we're at the top of the cycle, but I remain confident to invest in real estate because I am investing for cash flow with my downside protections. So if I have the cash flow, I know it will cover the debt. It will not ever to be forced to sell. I can preserve my hard-earned capital and compound on it. Next, Yan will talk about her journey.
All right. My real estate journey started with a surprise. At the beginning, I thought I had financial freedom. I had decent income and proud to make money using my brain, and I'm not a slave of mortgage. Then some company announced that they will acquire my company because of the good performance. The moment I heard about the announcement, I immediately started looking for a job because my legal status depends on my job. My coworkers was very surprised by my departure. They asked me, "Why are you leaving? They promised not to change our business." But 2 years later, after I left, the whole department was completely restructured. My ex-coworker, who was a senior trader, told me that he realized how difficult it is to find another job with similar income when you are high in the corporate ladder, especially when you only have a few years left to retirement. People just don't give you a second chance. That's when he realized how important it is to grow passive portfolio. That was my aha moment. I immediately shift my mindset and bought a two-family where I house hacking and get good cash flow. However, it's too slow to scale it up, and I don't enjoy landlording. So I did some research and I found out passive investing, which provides me passive income regardless whether I'm sleeping or I'm working. So I would like to share with you some of my lessons. First, manage the risk before bad things happen. Sometimes good things can turn into bad things, like the company was acquired by another company due to good performance, and we all lost jobs. You are more vulnerable than you might think. I also hear investors told me that, "Oh, I don't want to invest in a boring asset class because right now the stock market is great." And the same investor told me later, after the stock market crashed, he said, "Oh, I don't have the money to invest right now because I lost a lot in stock market." Well, if you don't diversify your portfolio, then that's what you get. Second, you think you get financial freedom? Think again. You have a high income? Think about all the tax you pay. You get a salary boost when you change your job? Think about all the 401k you forfeited due to the vesting plan. The real financial freedom does not depend on your employer, does not depend on how long you work or whether you're sleeping. the money grows itself. The third thing I learned is that I can easily apply all the skills I learned from Wall Street to real estate. I can easily apply risk management experience, analytical skills, and portfolio construction techniques to real estate investing. Compared to the financial markets, real estate data is a lot less. And once you found a long-term trend, you can simply write on it. That's why data analytics skills is such a powerful tool in real estate investing. Next. What makes our company different from others? First, I want to highlight that we apply a holistic view of portfolio management, which is very common in financial industry to real estate investing. A lot of people think of their portfolio as just buying stocks, but your portfolio is actually broader than that. It includes your W-2 income, your company stocks, the stock options, and government bonds, corporate bonds, stocks, and real estate investing. Using this broader definition of portfolio, you can correctly assess how vulnerable you are to the financial turmoil. Let's take an example. If you work for a tech industry or financial industry, your portfolio already have a lot of upside potentials as well as downside risks. When the market tanks, your W-2 income, your bonus, your company stocks, options are all at risk. So it might make sense to add a little bit boring investment to your portfolio. On the other hand, if you work for a school, your portfolio is probably very stable. So you might want to add something exciting to your portfolio just to balance it out. The second chart highlights the gist of modern portfolio theory. The y-axis is expected return. The x-axis is the risk. The upside curve describes the trade-off between risk and return among risky assets. The best risky assets are located on this upward sloping curve. If you draw a horizontal line, the expected return are exactly the same for the two portfolios. One is on the curve, the other one is to the right of the curve. Now you can see with the same return, the one on the curve has the smallest risk. If you draw a vertical line with all the same risk, your expected return is much, much higher if the asset is on the curve. So that's why you want to find a risky asset on the curve. Now, if you add the risk-free assets, such as treasury, to your portfolio becomes the straight line connecting the risk-free asset to the risky asset. You want to find the slope of this curve, which is the so-called Sharpe ratio. It measures how much return you get compensated by taking additional risk. The goal is not to get the highest return, but the highest Sharpe ratio, which is the tangible portfolio here. We like this risk-adjusted return concept so much that we design our logo to capture this concept. The third philosophy is that we help investors to invest with confidence. We provide free content. We also make investment decisions based on data and not our gut feeling. We vet the sponsors and we do independent underwriting for each deal. All of this help our investors to make their own decisions much easier and with confidence. Last but not the least, you should invest with people that you trust. We understand the frustration of the passive investors as we are one of them, and we provide one-stop solution to make it easy for passive investors. We also co-invest with our own money, and our interests are perfectly in line with yours. We believe in long-term relationships and not the transactions come and go. Next. So this one highlights all the hurdles that passive investors may found. First, if you're too scared to invest, you feel like you know nothing about investments. Second, you might have no time to do all the research, or you have time but no deal flow. Next hurdle is that you can't tell the good deals from the bad ones, or you have more deals than you can possibly evaluate. When you finally finish your independent research and decided to pull the trigger, the deal already oversubscribed within 24 hours. The last hurdle is that maybe you only know one or two asset class, so your portfolio becomes over-concentrated. Next, as Sharp Investor Group, we are very keen to provide you a one-stop solution. If you are too scared to invest, we provide you the free educational content through a weekly newsletter, as well as an hour-long webinar. We conduct research on economies, market cycle, asset class, and regions. We also have a strict sponsor vetting process, and we maintain a long-term relationship with the good ones so that we can get access to their deal flow. We also underwrite independently, and we do it in a scalable way. We co-invest with our investors to get access to the good deals without overcommitting too much capital into one deal. As we gather more and more like-minded passive investors, we can leverage that to negotiate better terms with the sponsors. Lastly, we try to build a more diversified portfolio across different regions, different strategies, and different sponsors. We understand your struggle, and we will be there for you. We invest together with you. Next, let's jump into the second part, the opportunities. So first, I will start with sharing my story of this investment. It's like a roller coaster. I'm sure in the next 20 minutes, you will experience the same thing. But I ask you to give us 20 minutes and empty your glasses, because if you don't, whatever we say, it will just spill over. If you open up your mind and let the data do the talking, then you can make an informed decision whether this is a good investment or for you or not. Remember, we are not going to present you our personal opinions, but rather the facts. Numbers won't lie, regardless you like it or not, or you understand it or not. So I heard about these opportunities when I was on a road trip. I saw the email coming in from a sponsor I have huge respect. I look at the title, I immediately kill the deal because I have personal opinion about this industry. When I came back, his email arrived again. This time, I actually take time to question myself. How come a guy like him that I fully trust thinks this is a good deal, but I immediately killed him? Is there any possibility that he sees something, but I don't see it? Just out of curiosity, I started reading his pitch and do my own research. The more I research, the more I feel like peeling an onion. I'm amazed by the unseen facts and how delicate the deal is structured and how much protection it provides to the investors, which is exactly what we need right now, given all this uncertainty in the market. Fast forward 5 months later, not only did I invest in this deal personally, I also set up a fund to help investors to invest in this deal. And we got very positive feedback from investors last month when we did the first raise. So instead of you doing all the research, I am giving you my research for free. You can do your own research on top of mine if you want, but I just want to make this journey less bumpy. I almost missed this opportunity because of my misconception, or maybe because of my bias. Glad that I record that Mr. Neubawa, who is the mad data scientist in real estate investing, once said, data beats gut feel by 1 million miles. Next.
Well, thank you, Yan. So now here's the big reveal. We are investing in the ATM business. We're investing in the Prestige Investment Group. Prestige and its affiliated company are the top 5 owner-operator, and they plan to add 1,000 ATM across 8 states. Some are in the Northeast and some in the Southeast. They have a long track record and never missed a distribution payment. The core strategy is to acquire existing ATM contracts with long transaction history and handpick those that are highest transaction volume and upgrade those with new ATM. Because they have strategic partnerships with well-known retailers, they're able to win location contracts with McDonald's, Walgreens, CVS, and other Fortune 500 retailers. Now, this model is not something that the competition can easily copy. Prestige will replace the ATM with new machines and new technology to capitalize on digital advertising. The cash flow is generated by the transaction fee between $2 to $3 per transaction, and is split between the retailer, the ATM operator, and the investors. So the retailers are happy because the ATM brings in foot traffic and increased sales. So in summary, this is a quasi-real estate play because ATMs are located in attractive location with strong transaction records. If you can see an average of 500 transactions per month going back years, it just makes a very compelling business case. So also here's a high-level investment summary. So the fund is projecting a 7 years hold. Our investment fund will pay out 21% cash on cash after paying expenses. The minimum investment is $53,000, and your investment goes into purchasing the ATM. Investor will receive the first distribution 4 months after the investment has been made, and the monthly thereafter. We intend to use the bonus depreciation to write off 100% of your investment amount in that year. This is not tax advice when you want to talk to your accountant, but this is very consequential for passive losses. If you invest in $53,000, and you should anticipate $53,000 of passive losses. If you don't have the gain to offset that, you can also carry that loss to future years. So now let us address two most common questions from investors. The first question, is a society becoming cashless? And our second question, will technologies like Google Wallet and Apple Pay replace cash and make ATM obsolete? So let Yan first address the first narrative about cashless society.
Okay, I will just let the data do the talking. Next. The first type of demand, if you can zoom in, is what we call cash by necessity. The chart on the left shows the currency in circulation from 1995 to 2019. The first thing you will notice is that how steady it grows year over year. The second thing you notice is that after 2009, the growth rate actually accelerated. Lastly, as of July 2020, it reaches 2 trillion. That's a lot of zeros. The chart on the right, if you can zoom in, it breaks down the growth rate by month for the most recent 4 years. You can see how predictable the growth rate is. Every year, the pattern just repeats itself. One exception, though, is February 2020, when COVID broke out, we saw the growth actually spike compared to a historical level. This is a strong proof that ATM is a recession-resistant play. Next. Okay, so you might wonder why nobody around me use cashes, and yet the demand for cash is growing year over year. What goes wrong? Where is the disconnect? Turns out that there are 30 million US households classified as unbanked or underbanked, meaning that their income is so low, they cannot even afford to have a bank account. Without a bank account, they cannot use credit card, Zelle, or Venmo. They have no other ways to pay except for cash. So the chart on the right, if you can zoom in, it gives you the demographic breakdown of the underbanked or unbanked population. Given that the demographic change takes generations, the need for cash will stay for a long time. Next. Okay, let's talk about cashless society. It's been a topic since 2000. However, here we are. In July 2020, federal legislation passed the law, Payment Choice Act, to prevent retailers from going cashless at the federal level. At state level, a lot of states such as Massachusetts, New Jersey, New York City, San Francisco, and Philadelphia already passed state laws to prohibit cashless activities. Now let's move on to the next one. The second type of demand for cash is what I call cash by choice. Let's do some quick quiz. Are the following statements true or false? First, young people use cash more than the other payments. Is it true or false? Surprisingly, people aged between 18 to 25 years old use cash with 34% chance. The second place is the people aged 65 plus. They use cash with a 33% chance. Second statement, the average consumer carries less than $10 in cash. This is not true. The average amount is $60 in cash. Third, consumers use debit cards for most small value transactions. This is also not true. Half of the transactions lower than $10 are cash transactions. For the transaction between $10 to $25, cash and debit cards are used equally at 33%. The chart on the right gives you the breakdown of the top locations for cash transactions. The top three are fast food restaurants, coffee shops, grocery stores, and gas stations. Together, they constitute 54% of the cash transactions. Next. I really like this slide. It clearly shows our independent thinking. A lot of people confuse ATM with cash. They also don't understand which is competing with each. I want to give you a bigger picture about the competition landscape. We already mentioned that 30 million US households, they don't have a bank account and have to rely on cash, even though most of us use credit cards. That's why you see this yellow dotted line here, meaning that they are not competing with each other because they target different audience. For the cash user, how do you withdraw cash? There are two options. One, you go to the branch at business hours and wait in line and then get the cash. This is like driving on the local road. It's very, very slow. Second option, you use the independent ATM machine at your own time and there's no line. So it's like driving on the highway. These two are competing with each other. Okay, the third line is the credit card and the digital wallet. You don't need cash to pay for goods or service. It's like taking a plane to fly from one place to another. But just like the airport won't kill the highways and the local roads, the credit card, digital wallet, branches, and ATMs can coexist for a long time. Among all the non-cash users, digital wallet is actually competing with physical credit card. So to summarize, ATM is competing with branches to withdraw cash. Credit card is competing with digital wallet, but none of them will kill cash or ATMs because they are not completely in the same lane. Next. Okay, so this slide clearly reveals that ATM is winning the competition with the branches due to its low cost and convenience. Next.
All right, thank you, Yan. So now let me address the technology risk. Some of you may be using mobile payments like Google Wallet or Apple Pay, and the common perception is that they threaten the future for cash. And I get it. I personally like using Venmo and Apple Pay because they're convenient. But I think the fear may be overly exaggerated by the media. So let's take a look at the data. Okay, first, this is a demographic play. So where we focus on the unbanked and underbanked population. The FDIC conducted a survey on this segment of the population, and 49% said they don't have enough money to meet the minimum balance. And that's the #1 reason for not having a bank account. And I highlight that in the red here. And it's sad, but there are tens of millions of Americans with a net worth of $600 or less. And when you have a low net worth, and it just doesn't make sense to keep a bank account. There are low balance fee, late fee, and they add up. And that's why so many people have been pushing to the unbanked and underbanked. And that's the whole point. You do need a bank account in order to connect to Venmo or Apple Pay. And if you don't have a bank account, it doesn't matter what new apps you have, you're still using cash. But mobile payment must be taking market share from somewhere. And the question is where? The data shows that it is taking market share away from bank teller, like Yan has said, and also online banking, which is surprising, but they're not taking market share from cash and ATM. Let's look at the ATM usage by percentage, and you will see that it remains flat. You see this red box here, and it will likely continue the same trajectory. Now, even though the smartphone market is very mature, over 75% of Americans already have smartphones, but there's only 34% of them use mobile banking. And why is the adoption rate for mobile banking slow? So, well, many mobile users are still hesitant to bank using smartphone because of safety and privacy concerns. Here are two important statistics per Pew Research Group. So first, consumers still view mobile payment as poorly protected compared to traditional methods. That's 38% compared to credit card of 9%. Second, consumer trust protections on debit and credit cards more than those on the mobile payments. Nearly 30% of consumers avoid mobile payments because of concerns of loss of funds. And this is no surprise because we do hear a lot about computer hack and identity theft all the time. This is a roadblock to adoption, even though smartphones have been around for a long time. Now let's talk about some of the longer term future. Will ATMs still exist in the next 7 to 10 years? Now, COVID is a major accelerator for mobile technology, and some banks have already rolled out ATM with contactless technology. It connects with your phone using NFC or apps like Apple Pay. I call this ATM 2.0. It's quite easy and more secure than a card. I also predict that the next generation ATM, maybe 3.0 in the future, will become a smart cash dispenser. There'll be no screen, no pin pads, no credit inserts, because all your data is already stored on your phone. There may be a future where credit card becomes obsolete, but as long as the core demographic using cash, ATM is going to stay. I would also make the case that the banking technology, or even as the currency evolves, ATM will evolve with it. Already we're seeing the rise of number of Bitcoin machines in selected markets. People can use Bitcoin ATMs to withdraw cash. I'm sure there will be new finance technology or more people are adapting to crypto, but at the end of the day, if you're hungry and you need to buy a banana and the vendor only accepts cash, you're going to use ATM. So yes, there is a risk, but based on structural reasons that we talked about core demographics and privacy concerns, cash and ATM are going to coexist with whatever new tech that comes along. And it's a risk that I'm willing to take, especially when you see the return profile, which I think is very compelling. So here's a quick recap of the data section. Number one, cash is still the primary payment method, especially for under $25 transaction. Cash is still king. Number two, there are still tens of millions of Americans who don't have bank accounts, so they will continue to rely on ATMs for the foreseeable future. And number three, both the consumer and the banks prefer ATM over branches, and payment apps are competing with credit cards, but cash is still necessary. And finally, ATM will evolve and coexist with the new tech. So next, I will describe how the ATM business work. So I believe we presented the case for ATMs, and hopefully you're convinced that cash is not going away. Now let's talk about the ATM business and the operator. Now the ATM business is a very interesting business. Here's a back of the envelope and estimate for the market size. If we take the daily transaction multiplied by $2 to $3 per transaction fee and multiplied by 500,000 ATMs, this market generates a rough estimate of $4 billion of top-line revenue per year. It's clearly a very profitable business. But how do you get exposure to this market sector? There are two primary ways to invest in this market. You can be the mom and pop owners whose main focus is to place the ATM in new locations. It can be a very lucrative business. People do this and they don't need investor capital. They place ATM in new location and there's much less certainty of the cash flow and it's much more challenging to scale. The other side of the business is the institutional operators with multiple location contracts and with existing retailers. Yes, there is a lower margin than mom and pop, but there's much more predictability and you can get much better economy of scale. If all the McDonald's have an ATM in a geographical location, they're usually managed by one company. So Prestige does have a contract like that with McDonald's in New York City. Next, we want to talk about why Prestige. They are the top 5 owner and operator of ATMs in the US, and they have ATM across 45 states. The manager has invested in several funds, and this is their 9th. They launched its first ATM fund in 2012. Since then, they have raised more than $100 million of equity and have purchased or managed over 10,000 ATMs. The first fund started in 2012 and has gone full cycle, and they have never once missed a single cash distribution. Now, we know COVID is the mother of all sensitivity tests, and they only saw a drop in traffic of 11%. Also about their team. One of the members of the senior executive is also an executive of Catronics, which is the largest ATM company in the world. Now, also, the management company is certified as an independent ATM deployer. Now, the banking sector is highly regulated, and if you're going to be the owner-operator, you need a sponsor bank to do that. So the sponsor bank require you to provide a third-party accountant, financial audits, and regular reporting. The sponsor bank for Prestige is MetaBank, and they also is the issuer of the stimulus money via the EBT cards. So the sponsoring bank put their license on the line and pretty much said Prestige is under the umbrella and they're in compliance. Now, this is a few cases where the regulation is working in our favor as an investor. Lastly, the ATM portfolio is institutional quality, both in size and retailer. So it includes ATMs located in many well-known places, such as Walgreens, McDonald's, Walmart. You can see that list right here. So when we are investing our capital, we want to invest with experienced operator with long track record and a high degree of sophistication. Next, let Jens talk about risk management and financials.
Okay. As a risk manager, I couldn't stress enough the importance of risk management. Without risk management, the return projection is just wishful thinking. As we all know, the projection can be easily manipulated. The goal of risk management is to assess how likely you will achieve this expected return. Next. To answer the question, how do we manage the risk of this deal? We need to ask backwards. How can a deal go south? In my mind, there are 4 types of risk. The first one is economic downturn. The second one is working with the inexperienced operators. The third one is misalignment of interest. The last one is over leverage. Now let's take a look at this deal and see how it mitigates all this risk. So first of all, using historical data, we've already shown that this strategy is well designed for economic downturn. We've already seen that the demand for cash and the ATM transaction volume are stable and predictable year over year and outperform in economic downturn. According to FDIC survey during the Great Recession, the underbanked and unbankable population actually grew from 7.6% in 2009 to 8.2% in 2011. The deal is to design to have a 25 to 30% buffer, which means the payout to investor will not be affected, even if the transaction volume dropped by 25 to 30%. As a matter of fact, in March 2020, when the lockdown begins, the transaction volume dropped by 11% that month. That was the worst case in the history. However, it never affected the payout to the investors due to this built-in buffer. We also saw the transaction volume quickly bounce back to pre-COVID level. Lastly, I would like to point out that the 12% digital marketing upside is not included in our underwriting model, as we will see in the next few slides, just to be conservative. The second type of risk is working with inexperienced operator. We already talked about the reason why we like Prestige. They are one of the top 5 and they have 10,000 ATMs and 100 million asset under management. They passed strict regulation rules to become a certified independent ATM deployer. Most importantly, their previous fund finished the full cycle, and they have a stellar track record. They never miss any single monthly payment throughout the whole investment period, even during COVID. Thirdly, the interest of the operator is perfectly aligned with investors. They put their own money in, and they get compensated after the investor. So they're motivated to work hard to pay you the returns before they get paid. Last but not the least, we saw in 2008, a lot of deals went busted because people got greedy and they over leveraged. But in this case, there's zero leverage. This means that the risk is significantly lower and no bank will get compensated ahead of you. Investors are the first one to get compensated. Next. Let's talk about due diligence. A lot of investors ask us, I understand this strategy. The returns look impressive without taking any leverage. But how do I know this is not a Ponzi scheme? In other words, how do I know there's a real business activities behind those numbers? That's very good questions. Every investor should ask that kind of questions. Here are some due diligence activities that our teams, mainly my mentor, who is also a consultant of this deal, performed. Okay, first of all, the team reviewed the results of the fund, which just finished the full cycle. It shows that it never missed any single monthly payment throughout the whole investment period, even during COVID. Second, the team randomly checked the numbers in the ATM management software and saw all the real transaction volume per ATM. The team also visited the ATMs across 3 states and reviewed the wet signed location contract with the Fortune 500 retailers. The team also paid visit to Prestige's office and had conference calls with their principals. We also did the independent industry research to make sure that the numbers are not too good to be true. I would like to point out that such due diligence cannot be done at individual passive investor level. As the sponsor, they just don't have the bandwidth to deal with every single investors. That's why this is one of the benefits of the co-investing, because you get someone to work for you for free. You just need to take the free ride. Next. Okay, let's look at the underwriting model. I know there's a lot of data, and don't worry, you will get the PowerPoint tonight or tomorrow, and also the video. So you can take a look at the numbers and beat them up when you have free time. But I will just highlight the things that you want to look at so you know where to look. Let's start with assumptions. Please note that all pro forma are projections. It can be easily manipulated. Reviewing the assumptions is very, very crucial to determine whether the good return is due to some crazy assumptions or it's really a good business. And a good sponsor is very transparent about the assumptions, while the bad ones don't want to review the assumptions for you. So first of all, the minimum investment is $53K, which includes $1,000 one-time setup fee, mostly cover the legal fees. The remaining $52K buys you 3 new generation ATMs, which can do a lot more than just cash dispenser, and also 3 7-year location contracts with the high traffic store owners. At the end of year 7, every ATM is sold for $500. So total is $1,500. We also assume that we only have 10 investors to share the monthly expense, just to be conservative. The more people co-invest, the lower average expense to each investor. So you are more than welcome to connect us with people that you think might be interested in this deal. So the first thing that I want to highlight is the income. That's the income that our fund received from Prestige. Please note that we don't include any 12% of the digital marketing revenue, even though it's very common in Europe, it's still in the early stage in the United States. So we want to conservative. Okay, the second component of the table is expense. As you can see, all this expense are the expense paid to the third-party vendors, such as the CPAs and bookkeepers. So please know that we don't pay ourselves. So we work for you for free. Subtracting the expense from income, you can get the distributions to the investors. You also get 100% bonus depreciation in year one. Assuming your tax bracket is 40%, this boosts your total distribution in year one to be 30,000. This means that although you get positive cash flows in year one, the tax form says that you have a huge paper loss, so you can use that to offset your passive income. If you don't have enough passive income to net, you can defer to the future. We also want to highlight that at the end of year 7, the 3 ATM machines are sold for $1,500, so there's no depreciation recapture. This is great. If you get 100% bonus depreciation in year 1 and you don't have to pay it back to IRS in year 7, this is a huge benefit under Biden administration because you are expected to pay a lot more higher tax. At the end of the bottom, we also highlight IRR, which provides an apple-to-apple comparison of different deals. Without taking the tax benefit into account, the deal is expected to generate 11.5% return every year. Please note that this is achieved by not taking any leverage. As a comparison, multifamily has similar IRR, but it takes 60 to 80% loan. So we are getting similar returns without taking risk. The risk-adjusted return is much, much higher. If you take into account the tax benefit, the IRR boosted to be 23% every year. You can take a look at the numbers, and if you have any questions, please let us know. We are here to help. Next. This page discloses everything that you need to know about our fees. First of all, there's a 0% acquisition fee. This means we don't get paid by how much capital we raise. Second, 0% asset management fee means that we work for you for free for 7 years. This is because we just started and we want to give back to investors as much as possible, even though it means that we work for free and we pay the expense out of pocket at the beginning. But don't expect this to be the norm though. There's a 1,000 per unit one-time setup fee to cover the legal expense. There's no other hidden fees. The one thing that we get is the 10% split and you keep the 90%. This fee structure is unheard of. If you have access to a lot of deals, you can do the comparison and it shows how much our interest is aligned with yours. Next. Okay, now we move on to the last session, portfolio management. Why is this important? Sometimes investors tell me that I like the downside protection of the deal, but I don't feel the upside exciting like Bitcoin. I wish I have both. This reminds me of an old joke when I was a little kid. So the joke is this: someone is really good at selling any merchandise. So one day he told people that he has the best spears in the world that can penetrate any shell. At the same time, he also told people that he has the best shell that can survive any spears in the world. So people ask him, what would happen if you use your spear to fight against your shell, right? So it's a joke, but I want to let you know that any deal cannot be the best spear and the best shell at the same time. So now you might be interested to know, is there a way to actually enjoy both the upside and protect the downside? The answer is yes, but it's not done through one single deal. It's achieved through portfolio diversification. If you only have one deal, you cannot have both. But when you have multiple deals in your portfolio, some deals can provide you with the exciting upside. The other deals provide you the downside protection. As a result, you achieve higher risk-adjusted return which is measured by higher Sharpe ratio. Taking a holistic view of portfolio management is what sets us apart from our competitors. Next. Now let's take a look at how diversification can improve the performance of your portfolio. Here I use two portfolios to illustrate my point. One is the concentrated portfolio with 100% investment in S&P, which is represented in the blue bar. The other one is the diversified portfolio with 50% in S&P and 50% in ATM, represented in the green bar. Both portfolios start with 53,000 initial investments, and we want to see the value of the portfolio at the end of year 7. The histogram on the left show you the possible outcome. The x-axis shows you the possible outcome of the portfolio at the end of year 7, while the y-axis tells you the probability of each scenario. For instance, if you look at in the middle of the chart, the concentrated portfolio achieves annualized return between 6 to 9% every year with 16% probability. So the first thing you will notice is that the concentrated portfolio outcome is much more unpredictable, measured by how wide the spread it is, compared to the diversified portfolio. Its annualized return can range from losing 3% every year to making 21% every year. The uncertainty of the end result is what we call risk. You can see how widespread the result is. As a comparison, if you look at the diversified portfolio, its annualized return range from 6% to 21% every year. It's much more predictable. Second important thing that you notice is that how likely your portfolio will end up losing money. We noticed that for the concentrated portfolio, it has a 5% chance losing money every year, while the diversified portfolio never lose money according to the historical data. In other words, diversified portfolio provides a downside protection to your portfolio. Now let's shift focus to the middle of the chart. You want to know how likely your portfolio makes an annualized return between 6 to 15% every year. For the concentrated portfolio, the probability is 16 plus 9 plus 26. Total is 51% probability. Not bad, right? As a comparison, if you look at the diversified portfolio, the probability is 20 plus 26 plus 38. So total is 84% probability. Even more impressive, your diversified portfolio is 33% more likely to achieve a 6 to 15% annualized return. The table on the right summarizes the key statistics of the two portfolios. The average annualized return is about the same. It doesn't look too different from each other. However, the risk of the concentrated portfolio is more than double of the one of the diversified one. As a result, the Sharpe ratio of the diversified portfolio is much more than double of the concentrated one. In other words, diversification improves the risk-adjusted return of your portfolio. Move on. Another question I got asked a lot after our last webinar in March is that, how do you compare ATM to multifamily? Because they are very familiar with multifamily and they want to use it as a benchmark. So I want to highlight the difference in 3 aspects: cash flow, leverage, and tax benefit. Please bear in mind that the point of this slide is not to say which deal is absolutely better than the other, because it depends on the market condition and your risk tolerance. Instead, we should think in terms of portfolio diversification. By adding this deal to my existing portfolio, can I achieve a higher risk-adjusted return? Okay, let's get started. The chart on the left shows you how cash flows are distributed among 7 years. The blue bar represents the ATM deals, while the orange bar represents the multifamily deal. First thing you will notice is that the cash flow distributions are completely different. The ATM deals distribute like evenly across 7 years, while multifamily has minimum cash flow at the beginning and highly concentrated in the last year, where you get your initial investment back plus the profit. Which one is better then? it really depends on the market. If the market is in the expansion cycle, you're more certain that you can get the huge gain at the end. On the contrary, if the market is contracting or the market is uncertain, like right now, you probably want to doubt how certain the large cash flow you can get at the end. So you might feel safer if you get the cash flow earlier. And I will also encourage you to think in terms of scenarios. What is the base case scenario? What is the best case scenario or the worst case scenario? Okay, the second thing is that everything being equal, even though you're 100% sure that you can get the huge cash flow at the end of year 7, you should also be aware of the time value of the money. Today's $100 is a lot more valuable than the $100 in year 7 because you can use the cash flow today to invest into other opportunities and let it grow. The fact that ATM deal distributes cash much earlier than the multifamily deal is an advantage because you can reinvest. Now, let's assume that, okay, now let's talk about the difference in leverage. In the multifamily deal, the loan to value is normally around 60 to 80%, while the ATM deal has 0% leverage. What does that mean? It means that multifamily deal, you are being compensated after the bank. In the rare case that the deal is not performing as expected, the bank is the first getting compensated. And there's a slight chance that you might lose your original investment or maybe making less profit than you thought. On the contrary, for the ATM deal, you are the first one being compensated. So it's much safer compared to a multifamily deal. Even after, even with the leverage, the two deals achieve same IRR, which means that ATM deal has a lot higher risk-adjusted return. The last difference is tax treatment difference. Please bear in mind that I'm not a CPA, so please consult with your CPA to see how this applies to your case. In both deals, you will enjoy the bonus depreciation. However, the amounts are different. The ATM has 100% bonus depreciation in year 1. So if you have 40% tax bracket, it translates into around 18,000 tax credit, which can be used to offset your passive income. However, for multifamily deal, nowadays you get roughly 40 to 6% bonus depreciation because land cannot be depreciated, and you also need to reserve a lot of cash when you borrow money from the bank. When you sell the multifamily in year 7, you have to pay the difference between the sale price and the adjusted cost basis to IRS. This is what we call depreciation recapture. On the other hand, the ATM machine already depreciates to 500 at the end of year 7. So there's no recapture at all. So in summary, for the ATM deal, you get 100% bonus depreciation and you don't have to pay it back to IRS. The multifamily, you get 40 to 60% bonus depreciation in year 1, and you have to pay it back to IRS at the end. So if you consider the tax benefit, then the ATM deal, the IRR boosted to 23%, and the multifamily deal IRR boosted to be 16%. Still very impressive. Okay, next.
Thank you, Yan. So this is a summary. I'll be wrapping up really soon. So let's talk about the next step. So we have already done an analysis and due diligence. So we just completed webinar today. So our target date for funding is the 15th. And between now and the funding, you can review all the legal documents and sign them back to us. So if this deal interests you and you want to invest, the first step is to submit your soft commitment by filling out the exit poll, and we'll launch it up when we get to the FAQ section. You can also send us your verbal commitment by the 9th. The third step is to go through a third-party verification website like verifyinvestor.com or other vendors to confirm your investor accreditation status. And the fourth step is to review the legal documents and ask any questions. So once it is completed, we can verify your status. We will send you the legal documents via DocuSign. And once that's approved, please wait for the wiring instruction and you can wire the funds into the account.
Okay, this is the last page. We want to say thank you for being with us for an hour. It's a lot of information to absorb. Thank you very much for your patience. We want to build a long-term relationship with you and not on a transactional base. We want to help you to invest with confidence and grow your passive portfolio. I hope today's presentation opens your mind about opportunities hidden in the asset class that you are less familiar with. I also hope that we showcase the value that we can deliver to our investors, and we are the one that you can trust to grow your passive portfolio in the long run. Thank you very much.
All right, so thanks for staying with us. So let's start with the Q&A. And we also have, I'm sorry, let's actually launch the poll first. So, so we don't forget. So here's the poll. And just to be aware, there's no obligation. So you can change your mind before the commitment date, but we wanted to capture who we need to follow up with. So it is launched now. So you go ahead and feel free to put in your information. And now also let's go through the questions in the Q&A. So let's start from the top. So thank you, Gary, for question.
I think, sorry to interrupt, just two things to add. One is that the asset poll is just soft commitment. There's no consequence at all. And actually the last day to soft commit without any consequence is April 9th, right? So please put into your soft commitment even if you just have very slight interest. And that's the way that you can move forward to see the legal documents, to do more research on your own. It's a way to buy your time. And before you actually wire the money, you can always change your mind. So don't feel any pressure. That's one thing I want to say. Second thing is that I do see we have some questions in live Q&A. Why don't we start from there? Instead of the one that on the page.
Yeah. So the first question that we have from Gary is, can these do these ATMs support cryptocurrency? And I'll answer that question. No, these machines are more of, it is upgraded from the traditional with the large monitors on top, and you can do a lot more things than on the old ones. You can actually sell. The operator are planning to provide, well, first one, you can do branding. So you can brand with like a bank, like Citibank. So you can charge them a fee for that. And you can also sell gift cards. You can also sell advertising on the large monitor on top of those ATMs. But currently it does not support cryptocurrency. Cryptocurrency is still in a way still early stage. The Prestige, actually the fund operator, do have some ATMs that support cryptocurrency as a more of a trial in in selected markets. And so far, I mean, this does not have a whole lot of transaction volume. I think people are holding on to the crypto, thinking that it would appreciate another 100%. So maybe at this point, there people are not using it to transact like a fiat currency at this point. So hopefully that answers your questions.
Right. Right. So just to add to that, we can describe, we didn't have time to cover this, but I will just describe some use case for this ATM machine. So basically, this is not the traditional ATM machine as like a cash dispenser. The reason that the store owner are willing to upgrade to this new generation ATM is because they see the upside potential. What kind of upside potential we are talking about? Henry already mentioned something very, very simple, right? So the bank branding, that gives you $50 to $100 per month. And the screen, the huge video topper on top of that ATM, they sell the advertisement that give you another income stream. And then the third one is that when the user use the ATM machine, they can capture the statistics of the user, their behavior, but they do not reveal the data about specific user. They aggregate the data and they sell it to, for example, marketing or data company. And another one that I would describe is that it's called proximity marketing. So when you walk through, pass by this ATM in CSV, your mobile phone can get a promotion saying that, hey, there's a McDonald's maybe 100 meters apart, then you can get $2 for free. And then you use that coupon to go there and buy something, right? So McDonald's has to pay them a monthly fee in order to send that proximity marketing advertisement to the cell phone. So those are the interesting use case that we know that it's already being used in Europe, but in US it's still not very popular. But Prestige actually install a lot of software on their machine so that they can realize those functionality. And I think it will keep evolving. Yeah. All right. So the next one.
Next question from UZ is how is the ATM related to our fund? Is it one data source?
I am not so sure about this question. So if it's not clear, our fund is invested in an ATM operator, which provides the second generation of the ATM and to place them in the stores with high traffic. So then they would just split the transaction, the surcharge fee and split it in 3 ways. 1/3 goes into the store owner, 1/3 goes to the investor, and then 1/3 goes into the sponsor. Actually, it's 40, 40, 20%. So that's why we can get this almost like a fixed income. So you have predictable cash flow due to this surcharge fee based on the transaction volume. I hope this answers your questions. If not, then you can just type in.
I think also to part of that, to add to that is the operator has been running multiple funds. They actually started since 2012, so they amass a lot of transaction records. And they also, before they buy out the existing contract from the current ATM, they already have those records. So they know exactly what they would expect to get. So it's very predictable. So they're not just have like one data source or one ATM, it's ATMs across geographically. So that gives the certainty of the data. So hopefully that helped answer that question as well.
Mm-hmm.
So
I think this also related to the next question from Jin Lee. He mentioned that in the presentation, average ATM transaction is 6 to 8 times per day. You mentioned that it's about 500 transactions for Prestige ATM. That's more than twice of the general average. How confident you are about this and why? This is very, very good question. It shows how much attention you pay to the details. Yes, exactly. So industry average is like a 200-ish transaction per month. However, because Prestige strategically select the location with high traffic, proven by their historical transaction. So they go into, for example, McDonald's. McDonald's already has some ATM with other sponsors. They pull the data and they see the data. If that meets their criteria, they start this negotiation and they say, hey, I provide you with this new generation ATM. And if they agree, then they just replace the old ATM. So that's why every single location, they don't bet on how much the transaction volume will be. They actually see the actual result. And how correct it is, I can tell you that, So everything we presented here, including the returns, are not guessed. They are all based on the actual transaction data. And because it's a diversified pool, that's why you get confident that you will have 492 transactions because it basically balance out the ATMs from maybe New York City or versus the other one in Connecticut, because they will have different transactions, right? So it diversifies, and then the average transaction volume is 492, right? So we are very confident, and we also mentioned that they have several funds already closed, and they never miss any payment. And also, don't forget, they have 25 to 30% buffer. Even if your transaction volume vary a little bit, it won't affect your payout, even in COVID. Okay.
Yeah, and it's higher than general because they place them in really well-known retailers, like we talked about, McDonald's, Walgreens, those places, definitely more than just the corner grocery store. So,
right.
Okay. So
The second question from Jun Lee is that, okay, let me see. The ATM landlord will get a fixed amount or a share of revenue? Very good question. So what you get is actually two parts. The first one is from the transaction fee. That part is actually a fixed amount. So your minimum investment is 53K, then the 21%-ish is what you expect from that transaction volume. So if they do a good job, they have higher transaction, they will capture the upside after you being paid, right? So what is the share of revenue? That's the digital marketing piece that I talked about. Regardless how much they can earn, because right now it's a little bit question mark because it's still early, right? So even if it's $1, you get the 12% of that part. Yeah. Okay.
Yeah, so in general, a third of the revenue, but not the digital, maybe not the digital monetizations. So, all right. So the next question also from Jen Lee is, so what is the difference between this round and the last one in March?
Okay, so there's no difference between this one versus last run, but this fund will stay open until the sponsor closes their fund. It's very close to their maximum raise already, and it's possible that, so first of all, we don't know whether they will have another fund soon. Second, we don't know about the terms. I will give you an example. I invested several months like before the March raise. At that point, I am already very impressed by their like a high cash on cash return, so I invest. But at that point, there's no 100% bonus depreciation. But in March, just several months after I invested, this one, they have the 100% bonus depreciation. This is all like a negotiation between different parties. And I think also because this year, people worry about the tax hike. So it becomes important to have this 100% bonus depreciation. But as of now, we were not certain whether there will be another one or next month, whether it will be different or whether it will still have the tax benefit. We don't know. Every month we have to reconfirm with the sponsor. So hopefully that answers your question. Okay.
Go next. Next question from UG is, does Prestige have any disclosure about the operations and slash past operations?
So not sure about the disclosure. If you are talking about like they publish their financial statement, the answer is no, because they are not public company. I asked for that. What they will share is that I actually see it with my own eyes, is that they pull up the report for the recently finished the whole cycle fund, and I actually see how much investors get every month. But other than that, they wouldn't share with you their expense or their income. What you can see is, as an investor, you will get the report every quarter, tells you how much you get. That you will see. Yeah. So hopefully that answers your questions.
All right, next is how is that related to real estate investment?
Yes, this is a asset class with real estate play because it depends on the location. Obviously, if you put an ATM in like maybe west or middle west, that will be a significant different story because the foot traffic is different, right? So that's why it's a different asset class, but it has a real estate play here. Of course, there are a lot of real estate asset class. I personally invested in a lot of multifamily deals the year before, but my concern right now is that a lot of people know that multifamily is a recession-resistant asset class. That's no doubt about it. But the more people realize that, the more competition it is. And this ATM space, it existed for a long time, but a lot of people have misconception about this. That's why the competition is low. So it's not 100% related to real estate, but it does has real estate play in it. So that's, I guess, the best I can describe.
Yeah, that's a good question. And another question, Kathy Jang, and is that I may have missed it, but what happens at the end of the term? Do you get your capital back?
Okay, so Henry, can you go back to the cash flow part, the chart, the ATM versus multifamily deal? Yeah, Kathy, I want to highlight this to you because this is a very common question because a lot of people, they are very familiar with the cash flow distribution of a multifamily deal. So you are very used to this, at the beginning, there's just little cash flow, but at the end, there's a spike of cash flow. This is completely different from this ATM deal. The ATM deal, basically, without thinking about the tax benefit, every year you get the same exact cash flow every year, right? So as I mentioned, whether this is good or bad, it depends on the market, right? So I personally, this is just my take. You might feel differently based on your situation. My take is that when the market is uncertain, I don't want to wait for 7 years because I don't know what happened at the end of year 7. I would rather to get my money back little by little during the course of 7 years. So yeah, that's my take. And also, when I collect the money back, I can reinvest into other opportunities instead of, oh, my capital is holding 7 years and I only get it back at the end. And I cannot invest into other opportunities. Hope that helps.
Yeah, also to expand on that, the capital does come in as part of the distribution. So so you're getting part of your principal back on every month. So it's instead of waiting very much at the end, so you can redeploy your capital sooner than a multifamily deal. So hopefully that answers your question.
Right. So yeah, I will also add a little bit. The best way to think about this equal cash flow is that imagine that you want to pay your mortgage back to the bank, right? So every month you pay the same amount, but that same amount actually part of it is principal, part of it is interest. You can think of this cash flow that you get every year. Part of it is return. Part of it is getting your original investment back. So yeah, hope that helps.
All right, so let's go to the last but not least. What is the required raise for this round?
Not sure whether you are asking like for each investor or not. For each investor, the minimum investment is 53K. With the requirement that you have to be an accredited investor. What does accredited investor mean? So it's a SEC requirement. So basically, there are several rules, right? So you hit one of them that you are considered to be an accredited investor. The first rule is income, right? So if your annual income for the most recent 2 years is 20,000, 200,000, right? 200,000 if you are single, or if you look at the like a married couple, it's 300,000. That's the first criteria. Or you can use wealth criteria, which means that all your wealth is 1 million, but this does not include your primary residency. The third criteria is that if you pass Series 7, 80, 82, and 65, which is something that if you work for finance industry, then you probably will have. So, but there are other rules. As long as you are accredited investor, you are eligible to invest. If you are not, then continue to work on it. Yeah.
Okay, so I think that's last of your questions. If there's no more questions, I would like to end the call today and really appreciate and thank everyone's attendance. It's 6:25 and you guys still staying with us, so thank you so much. And any lasting comment for you, Yan?
Maybe you can go to our contact page. So if people have other questions, they can also send us an email.
Yeah, feel free to send us any questions and look forward to working with you very soon.
Yep. So it's very simple, yan@sharpinvestorgroup.com or henry@sharpinvestorgroup.com. The Sharp is SHARPE with the E. And you will receive a recording of this webinar and also the PowerPoint either later tonight or tomorrow. So feel free to reach out to us if you have any questions. And the last day for the soft commitment is April 9th. By the end of April 9th, we will send out the soft commitment to the sponsors so that they know that how many people will invest. Thank you.
Awesome. Thank you so much, everyone. Have a good night.
Thank you. Bye.